Hello, student. I'm Dr. Shefali Jain, Assistant Professor, Tirthankar Mahavir University. Student, in the previous video, we discussed about the national income, the definitions of national income, traditional definition, which is given by Marshall P. Fisher, and also discuss the modern definition of the national income. In this video, we discuss about the concept of the national income. But before discussing the concept of the national income, we briefly discuss what is national income. National income of any country means the complete value of the goods and services produced by any country during its financial year. It is thus the consequence of all economic activities that are running in any country during the period of a 1 year. It is valued in terms of money. In short, one can say that the national income of an country of any country is the total amount of income that is occurred by it through various economic activities in 1 year. It is also helpful in determining the progress of the country. It includes wages, interest, rent, profit received by factor of production like labor. The factor payment of the labor is wages, like capital. The factor payment of the capital is interest. Land. The factor payment of land is rent, and entrepreneurship. The factor payment of the entrepreneurship is profit of a mission. So, national income is the income of the whole country. In simple, national income is an uncertain terms which is used interchangeably with national dividend, national output, and national expenditure. On this basis, national income has been defined in a number of ways. National income means the total value of goods and services produced annually in a country. In the other word, the total amount of income accruing to a country from economic activities in a year's time is known as national income. It includes payment made of all resources in the form of wages, interest, rest, and rent and profit. There are various concepts of national income, including gross domestic product (GDP), gross national product (GNP), net national product (NNP), net domestic product (NDP), national income (NI), personal income (PI), disposable personal income (DPI). Now we will also discuss it in the detail. GDP. GDP, gross domestic product. GDP is the total market value of all all final goods and services produced in the country during a specific period, measured in money terms and not in physical units. So, GDP is market value of all goods and services produced with the domestic domain with the available resources during a year. GDP is equal to price value multiply quantity of goods and services. GDP is made up of four components: consumption, investment, government expenditure, and net foreign export of a country. GDP is equal to C plus, I plus, G plus, and X minus M. C means consumption, I means investment, G government expenditure, and X minus M export minus import. So GDP is the total value of goods and services produced within the country during a year. This is calculated at market prices and it's known as GDP at market prices. Uh, GDP at market prices as the market value of the output of final goods and services produced in the domestic territory of a country during an accounting year. GDP at factor cost. Also find out. GDP at factor cost is the sum of net value added by all producer within the country. Since the net value added gets distributed as income to the owners of factors of production, GDP is the sum of domestic factors, incomes, and fixed capital consumption or depreciation. Thus, GDP at factor cost is equal to net value added plus depreciation. Compensation GDP at factor cost includes mostly compensations of employees as wages, salary, etc. and operating surplus, which is the business profit of both incorporated and unincorporated firms. Operating surplus is equal to gross value added at factor cost minus compensations of employees depreciation. And GDP at factor cost and GDP at market price must be identical. This is because the factor cost payment of the factor of producing goods must equal the final value of the goods and services at the market price. However, the market value of the goods and services differs from the earning of the factors of production. In GDP at market price are included indirect indirect taxes and factor cost. We subtract indirect taxes and uh, so GDP at market price are included indirect taxes and are excluded subsidies by the government. Therefore, in order to arrive at GDP at factor cost, indirect taxes are subtracted. Subtract and subsidies are added to GDP at market price. I think you have to understood GDP at factor cost is equal to GDP at market price minus indirect taxes plus subsidies. Hope student you well understood. When we measure the GDP at market price, we included indirect taxes and are excluded subsidies by the government. And other hand, when we measure the GDP at factor cost, indirect taxes are subtract and subsidies are added. It means uh, indirect taxes excluded and subsidied included. So GDP at factor cost is equal to GDP at market price minus indirect taxes plus subsidies. Hope student you well understood what is GDP. Now we discuss about gross national product GNP. National product GNP is the total value of all final goods and services produced within a nation in a particular year plus income earned by its citizens, including income of those located abroad, minus income of non-residents located in the country. It means basically GNP measured the value of goods and services that the country's citizens produce regardless of their location. GNP is equal to GDP plus NEP. It means GDP is the total measure of the flow of goods and services. Sorry, GDP ne GNP. GNP is the total measure of the flow of goods and services at market value resulting from current producing during a year in country, including net income from abroad. GNP includes four types of final goods and services: consumer goods and services to satisfy the immediate wants of the people; gross private domestic investment in capital goods consisting of fixed capital formations, residential constructions, and inventories of finished and unfinished goods; goods and services produced by the government; and net exports of goods and services, and the difference between value of export and imports of goods and services known as net income from abroad. In this concept, GNP, there are certain factors that have to be taken into consideration. First, GNP is the measure of money in which all kinds of goods and services produced in a country during one year are measured in terms of money at current price and then added together. But in this manner, due to an increase or decrease in the prices, the GNP shows a rise or decline, which may not be real. So, to guard against erring on this account, a particular year, say for instance, example 1990 and 91, when price to be normal is taken as a base year and GNP is adjusted in according with the index number for that year. This will be known as GNP at 1990-91 prices or at constant prices. Secondly, you can take the base year 2010 and 11 also. In estimating GNP of the economy, the market price of only the final products should be taken into account. Many of products pass through a number of stages before they are ultimately purchased by consumers. If those products were counted at every state, they would be included many a time in a national product. Consequently, the GNP would increase too much to avoid double counting. Therefore, only the final products and not the intermediate goods should be taken into account. Third, goods and services rendered free or charge are not included in the GNP because it is not possible to have a current estimate of their market price. For example, um, the bringing up of a child by the mother, imparting instructions to his son by a teacher, recital of his friends by a musician, etc. Fourth, the transactions which do not arise from the produce of the current year or which do not contribute in any way to production are not included in the GNP. The sale and purchase of old goods and of shares, bonds, and assets of exiting companies are not included in GNP because these do not make any addition to the national product and the goods are simply transferred and with it The payment received under the social securities, unemployment, insurance allowance, old age pensions, and interest on public loans are also not included in GNP because the recipient do not provide any service in lieu of them, but the depreciation of machines, plants, and other capital goods is not deducted from GNP. And with it, the profit and or losses incurred on account of changes in capital assets as a result of fluctuations in market prices are not included in the GNP if they are not responsible for current production or economic activities. With it, as you can also, for example, if the price of a house or a piece of land increase due to inflation, the profit earned by selling it will not be a part of GNP. But if during the current year a portion of a house is constructed anew, the increase in the value of the house after subtracting the cost of the newly constructed portion will be so the increase in the value of the house after subtract the cost of the newly construction portion will be included in the GNP. Similarly, variation in the value of assets that can be ascertained before and are insured against flood or fire are not included in the GNP. The income earned through the illegal activities is not included in GNP, although the goods sold in the black market are priced and fulfill the needs of the people, but as they are not useful from the social point of view, the income received from their sale and purchase is always excluded from GNP. And there are two main reasons for this. One, it is not known whether these things were produced during the current year or the preceding year. Two, many of these things are foreign made and smuggler and hence not included in the GNP. GNP, it is essential to know how GNP can be estimated. Three approaches employed for this purpose: one, income method; two, GNP; two, second, expenditure method; two, GNP; and third, value added method; two, GNP. In the further video, we also discuss about the method of measuring GNP. Now, I think so. Basically, GNP measures the value of goods and services that the country's citizen produced regardless of their location. GNP is equal to GDP plus NFP. Difference between GNP and GDP. The difference is that GDP measure all production within the country, while GNP measure the value of goods and services that the country's citizen produce regardless of their location. I think student, what is the difference you have to understood what is the difference between GNP and GDP. I also explain it again. So in simple, you can see GNP is the market value of final goods and services produced in a year by the residents of the country within the domestic territories as well as abroad. GNP is the value of goods and services that the country's citizens produce regardless of their location. So GNP is equal to, as you seen in the screen, is equal to GDP plus NFIA. GNP is equal to You can also take GNP is equal to C plus I plus G plus X minus M and plus NFIA. Because we include in GDP C plus C means consumption plus investment plus government expenditure plus export minus import. And in the GNP, we also include GDP plus NFIA. NFIA, sorry, यहाँ पे NFP लिखा NFIA means net factor income from abroad. ये misprint हो गया है मे बी थोड़ा सा. So, so in simple words, gross domestic product is the value of the finished domestic goods and services produced within our national border. On the other hand, gross national product is the value of all finished goods and services produced by a country's citizen both domestically and abroad. GDP and GNP are both widely used measures of a country's aggregate economic output. GDP measured the value of goods and services produced within a country's border by citizens and non-citizens alike. GNP measures the value of goods and services produced by a country's citizen both domestically and abroad. Just like a GDP is the most commonly used by global economies, the United States abandons the use of GNP in 1991, adopting GDP as its measure to compare itself with other countries. Many sources now use the terms gross national income or as a synonyms for GNP. So, gross domestic product is the most basic indicator to measure the overall health and size of a country's economy. This metric count the overall market value and the goods and services produced domestically by a country. GDP is an important figure because it gives an idea of whether the country is growing or contracting. Calculating GDP includes adding together private consumption or consumer spending, government spending, capital spending by businesses, and net export. And it means exports minus imports, uh, all. So consumptions, यानी GDP is equal to C plus I plus G and export minus M. Consumption means the value of the consumption of goods and services equal to the consumed by the country's household. This account for the largest parts of GDP. Next, government expanding uh, all consumption and investment and payment made by the government for current use and investment spending on purchases of fixed assets and unsold stock by private businesses. Net export represent a country's balance of trade of the difference between export and import. A positive number indicates that the country export more than its imports because it is a subject to pressure from the inflation. GDP can be broken up into two categories, real GDP and nominal GDP. We will also discuss about it. What is real GDP? I think I should also discuss. A country's real GDP is the economic output after inflation is factored, while nominal GDP does not take inflation into account. Nominal GDP कह सकते हैं नाम मात्र की GDP, but real GDP has a main place. So nominal GDP usually higher than real GDP because inflation is almost always positive. Nominal GDP is generally used to compare different quarters. in the same year because inflation is usually not to be significant factor. The GDPs of two or more years or are compared using real GDP. GDP can be used to compare the performance of two or more economics, acting as a key inputs for making investment decision. It also helps the government draft policy to drive local economic growth. So when the GDP rises, it means the economy is growing, and it's opposite if it drops, the economy is shrinking and may be in trouble. But if the economy grows to the point of reaching full production capacity, inflation may start to rise. Central bank may then step in tight, and central bank also use the monetary policies to control the inflation and when and slow and also take many steps, and when the deflation is in this case the central bank raises the interest rate consumption and corporate confidence drop. During this period monetary policy is used to control the inflation. So, so GDP is also measured the livelihood and living standard of a and also indicate the growth rate of a country. Just like a GNP, yani gross national product, is another matrix used to measure a country's economic output, where GDP looks at the value of the goods and services produced within a country's border. GNP is the market value of goods and services produced by all citizens of a country, both domestically and abroad. While GDP is an indicator of the local national economy, while GNP represents how it's national and contributing to the country's economy. It factors in citizenship but outlooks location. For that reason, it is important to note that GNP doesn't include the output of the foreign residents. So, uh, GNP can be calculated by editing consumption, government expenditure, capital expanding by businesses, net export. Net export, I have also discussed here what is the net export? Export minus import and net income by domestic residents and businesses from overseas investment. This figure is then subtracted from the net income earned by the foreign residents and businesses from domestic investment. So, so hope student you well understood what is the difference between GNP and GDP. Now we discuss about net national product NNP. If we want to know NNP, then we will have to deduct depreciation allowance from GNP. We can write it mathematically as NNP is equal to GNP minus depreciation allocation and net domestic product NDP. If you want to know NDP, then we will have to deduct depreciation allowance from GDP. NDP is equal to GDP minus depreciation allowance. In simple, as I explain you, NNP, net national product, is a term that are often used to represent the difference between gross national product and depreciation. In numerical terms, NNP is the total market value of goods and services produced by a nation during a specified period, generally a year, a current year, with depreciation subtracted from it. The NNP is a tool generally used by economics to report on the growth and the strength of a nation state and can be used to evaluate a country's growth against other. It is useful comparative measurement and can provide indications to overall economic state of a country. Despite falling out of the use in recent time, it can still provide valuable insights into economic growth and market health. An NP is a tool generally used by economists to report on the growth and strength of nation state. NNP is a comparative measure that can provide indications on the overall economic growth and market health of a country. And the gross national product portion of NNP formula include all the final goods and services manufactured and produced within a country and within a period of time. So the NNP is generally represented by with a simple formula. NNP is equal to GNP. GNP means gross national product. I have also explained you the gross national product portion of the NNP formula include all final goods and services manufactured and produced within a nation with a so the gross national product I have net national product is equal to gross national product minus depreciation. The depreciation component of the formula is the represent of the depreciation of the assets held by the country. So I think you have to understood well how you can find out the net national product for a country. Net national product has a significance roles because net national product can help us to decide if a particular country is worth moving or to if the economy is growing at a pace that we feel comfortable being paid in the local currency. And thus, the net national product can be useful figure to understand and interpret especially when making comparison among the locals. So, environmental sustainability is a topic that concerns us all as global citizens. It is being suggested that the net national product depreciation should include an element that accounts for the natural resources and environmental depreciation. It will help measure the true impact of certain types of growth of the country, including what can be considered environmental assist, forestry, mining, toxin, fumes, will all weigh down and on the net national product and can provide a more long-term view of a company's strategic growth strategy. So, the measurement of environmental impact when calculating a country's net national product can be considered controversial. Difficulties will no doubt arise when attempting to create a precise measurement in determining how much depreciation the extractions of raw material should account for. So, hope student well understood how you can net national product NNP. Now we discuss about net domestic product. As you also discuss with you that just like a NDP, the net domestic product is calculating by subtracting the value of depreciation of capital assets of the nation, such as machinery, housing, vehicles, from the gross domestic product. The NDP also takes into account the other factors such as obsolescence and complete destructions of the assets. So, NDP is an annual measure of the economic output of a nation that is calculated by subtracting depreciation from gross domestic product. NDP is an annual measure of the economic output of a nation that is adjusted to account for depreciation. It is calculated by subtracting depreciation from the gross domestic product. NDP along with GDP, gross national income, disposable income and personal income is one of the uh, key point of economic growth that is quarterly basis reported by the quarterly basis. We've also discussed it in the further video. An increase in NDP would indicate growing economic health, and while a decrease would indicate economic stagnations. NDP account for capital that has been consumed over the year in the form of housing, vehicles, or machinery. The depreciation accounted for is often referred to as capital consumption allowance and represent the amount needed to replace those depreciation assets. So NDP is equal to GDP minus depreciation. The frequency and scope of such replacement can vary by type of capital asset. Machinery that is put to regular use may need parts replaced regularly until the entire piece of equipment is no longer usable. While that may take many years, varying expected damages of defects. There is a cycle of equipments, failures, and replacement. Parts of the machinery in a factory's production line may needs to be replaced while another set of similar machine continues to function within the same factory. So the acquisition of the replacement machine would be factored into the depreciation asset of the NPI. So I hope you well understood what is NNP and NDP. Now we discuss about the next component, national income, NI. NNP is the summations of market values of all the goods produced and services providing in our country. But NNP does not show what actually has been earned by the countrymen during a year. NI in NNP, the businesses taxes are also included, such as taxes do not represent the incomes of the people. According to no NI, we will have to subtract the indirect taxes and add subsidies in NNP. NI, national income is equal to NNP minus indirect taxes plus subsidies. I have also discussed about the NNP in the video. Now, next is personal income, PI. Personal income is the aggregate of all individual income which is received directly by the individual. If we want to know personal income, we will have to add transfer payment in NI and will have to subtract taxes on profit and undistributed profit from NI. So personal income is equal to NI national income plus transfer payment minus taxes on profit and minus undistributed profit. NI does not show how much amount are possessed by the people. There are the persons who get incomes without rendering and their services, as the case of transfer payment like pension, unemployment, allowance, etc. So, in the simple words, NI personal income refers to the money received by factors of production, whereas national income represents the income generated by these factors. The income of the government sector is considered as a part of national income, but not included in personal income calculation. So, personal income refers to all incomes collectively received by an all individual or household. in a country. Personal income includes compensations from a number of sources, including salaries, wages, and bonus received from employment or self-employment, dividend and distributions received from investment, rental received from real estate investment, and profit sharing from businesses. So, personal income is the amount of money collectively received by the inhabitant of a country. Sources of personal income include money earned from employment, dividend, and distribution paid by investment, rent derived from property ownership, and profit sharing from businesses. Personal income is generally subject to taxation. The terms of personal income sometimes used to refers to the total compensation received by an individual, but this is more aptly refers to as individual income. In most personal income, also called gross income, is the subject of taxation above a certain base in amount. Personal income has a significant effect on the consumer consumption. A consumer spending drive much of the economy. National Statistical Organization economics and analysts track personal income to a quarterly or half annually basis. So I think you have to understand what is the personal income. Now we discuss about per capita income. Per capita income of a country is derived by dividing the national income of the country by the total population of a country. Per capita income, if you want to find out the per capita income, जो total national income है उसको dividing the national income of a country by the total population जितनी भी देश में population रहती है country की उससे आप divide करके you can find out. Now, last is disposable personal income. Disposable personal income tells tells us that how much money per year do household actually have available to spend. To get this disposable personal income, we will subtract direct taxes from personal income. Direct taxes, income tax, property tax, etc. So disposable income is equal to personal income minus direct taxes. So disposable personal income refers to the amount of money that a population has left after taxes have been paid. It is different from personal income in that it takes taxes into account. So, uh, personal income is often compared to personal consumption expenditures. So, disposable income or disposable personal income is an economic terms for the money that is available for household consumption, saving, and spending after accounting for income tax. It is important indicator that is used by economics in determining the demand in an economy. Hope student in this video, you well understood the concept of the national income. Now, thank you. Thank you very much.